Imagine this. You walk into your bank one morning just to ask about a small business loan, maybe to open a cafe. The bank officer smiles, nods, types something into a computer and says, approved. The money's in your account. But here's the weird part, that money didn't exist 5 minutes ago. The bank didn't take it from a vault, and it also didn't came from another customer's deposit. The moment you signed the loan agreement, the money was created out of nothing but trust, regulations, and bookkeeping. Now imagine that process happening billions of times for everyone around the world. For homebuyers, corporations, governments, and that's how we get to this number. Over $300 trillion in global debt. But the real question is, if the world owes $300 trillion, who do we actually owe it to? First of all, yes, it is a real number. According to the Institute of International Finance, that's a group that tracks money around the world, the total amount of debt in the global economy recently passed $324 trillion. That includes government debt, so countries borrowing money, corporate debt, so companies taking out loans or issuing bonds, and household debt, like mortgages, car loans, or credit card debt. So when people say the world owes $300 trillion, what they're really doing is adding up all the debt that all governments, all businesses, and all households owe. And here's where it gets tricky, because it sounds like this is just one single bill that the world has to pay. But it's not. Debt doesn't flow in space. Because every dollar of debt is also someone else's asset. Debt and wealth are two sides of the same coin. So when you hear we owe $300 trillion, the more complete sentence would be we owe each other $300 trillion. But who or what is that other person or institution that has $300 trillion in assets? To understand who we actually owe all this money to, we need to explain a few key words in simple language. Let's start with the word creditor. The creditor is everyone that has lent somebody else money and expects it back, usually with interest. There are four main types of creditors. The first type are banks. Banks are the most common lenders. They give loans to people, businesses, and even governments. In return, they receive interest payments, and that's how they make money. The second group are bondholders. Bonds are just loans that you can also buy and sell as an individual. When a government, for example, needs money, it can issue a bond, basically saying, buy this bond and we'll pay you back in 10 years plus interest. And anyone can buy a bond, a bank, a company, or even you and me. So if you've ever put money into a retirement fund, for example, chances are you're already lending money to a government or company. The third group are foreign governments and international institutions. Sometimes countries borrow from other countries. The US, for example, owes money to Japan and China because they have bought US government bonds. Countries can also borrow from global institutions like the IMF, the International Monetary Fund, which lends to governments in trouble, especially in developing countries. And the fourth group are regular people. Everyday people can also lend money to other regular people, be it directly in their circle of friends or family, or through P2P platforms, for example, where you can lend money to other people who might need it. And as we already discussed, regular people like you and me can also buy bonds or other assets that are a kind of asset to a company or a government, for example. This shows us something important. The $300 trillion isn't owed to one person or one institution. It's money we owe each other through a complex network of promises. So let's come back to the earlier cafe example. Where does the money come from? Well, it's created when the loan is made. Most people think banks work like this. You deposit $1,000 into your account. The bank keeps it safe and then lends out part of your money to someone else. But that is actually not how modern banks work. When you deposit money, the bank doesn't put it in a drawer and wait to lend it out. Your deposit is recorded as a liability on their books. They owe it to you, but that money can stay right where it is. When they make a loan to another customer, they don't use up your deposit. Instead, banks approve the loan, record it as an asset, which means you owe them, and then create a deposit in your account, which is then money you can spend. And that's new money entering the economy. But there are limits, of course. Banks can't just create infinite amounts of money. They have to keep enough reserves at the central bank, like the Federal Reserve in the US or a European Central Bank. They have to meet capital requirements to stay financially healthy, and they have to trust that the loan will be repaid. If a bank needs more reserves, it can borrow them, sometimes from the central bank or from other banks. But the important thing is that most of the money we use every day is created when banks lend. It's not printed, it's not passed around, it's made in the moment of borrowing. And that is why debt and money are deeply linked. Let's come back to the headline number. Why is $300 trillion misleading even though it's technically true? Well, here are a few reasons. Number one, it's a total, not a balance. The number includes all debts, government, business, personal, all added together. But it says nothing about who owes what to whom and whether it's sustainable. It's like adding up every mortgage in the world and saying, oh, we're doomed. Debt is also an asset. Your mortgage is your bank's income stream, and a government bond is an investor's retirement plan. So global debt equals someone else's savings. Also, this number doesn't account for growth. Economies grow. If the economy grows faster than the debt becomes manageable. That's why economists often look at debt as a percentage of the GDP, the gross domestic product, instead. $300 trillion sounds scary until you remember that the global economy is worth around $105 trillion every year. And lastly, most of it is domestic. Most countries owe money to their own citizens or institutions, and the Japanese government's debt is mostly held by Japanese citizens. That makes it a lot safer than owing everything to a foreign country. So the number is real, yes, but without context, it misleads people into thinking there's one huge giant bill that the world needs to pay, which simply isn't true. So we've learned a bunch of useful stuff now, but there's still one thing that we haven't answered yet. Should we try to eliminate all this debt? The short answer is not necessarily, and here's why. Reason number one, debt is how economies grow. Governments borrow to build roads or hospitals. It can boost long-term growth. When businesses borrow to expand, they create jobs, and when students take loans for education, they may earn more money later. In these cases, debt is an investment. It opens doors. It's not a burden. Which also means that not all debt is bad. Some debt is dangerous, like short-term borrowing just to pay interest on old loans, or when people borrow more than they can repay. But productive debt, as mentioned in the last point, used for useful things, that kind of debt helps economies move forward. And also, trying to eliminate all debt could actually backfire. If everyone was trying to pay back their loans all at once, the money supply would suddenly shrink dramatically because so much money was created by loans. And that could cause a collapse in spending, investments, and even jobs. So the goal shouldn't be zero debt. The goal should be a healthy and sustainable debt used for the right purposes and at manageable levels. In other words, debt is a great tool and not a disease. So we owe the money to each other through banks, bonds, retirement funds, and everyday financial relationships. It's a system built on trust, contract, and the promise of future repayment. But that giant number can be misleading. Most debt is used to finance progress, like homes, businesses, infrastructure. It only becomes a problem when it's used recklessly or when borrowers can no longer repay. We shouldn't aim to erase all debt. We should aim to understand it and use it wisely. And if you've made it this far, you now understand more about how the financial world works than 99% of people. I promise you that. And if this helped you, leave a like and drop a comment with a question that you'd like to have answered next. I'd be happy to turn your curiosity into the next script. So thank you very much for watching, and I'll see you in the next video.